Recently, many people in the investment circle are debating if this is a good time to start investing in ETF. Some common questions investors ask are what kind of investment an ETF is, how to invest, where to start investing, how to choose an ETF. Today, this video is to bring you closer to understanding ETF. First is a disclaimer. Please do remember that the content shared in this video is intended to be used and must be used for informational purposes only. It is very important to do your own analysis before making any investment based on your own personal circumstances. You should take independent research and also verify any information before making an investment decision. ETF, the full name is Exchange Traded Funds. They are hybrid investment vehicles that can offer relatively low cost and tax efficient exposure to a variety of asset classes and investment strategies. ETF are similar to unit trust funds. Unit trust funds invest in a basket of stocks, giving investor a diversified portfolio. By a single purchase, investor gets exposure to a big variety of stocks that share certain characteristics. The difference is ETF trade on a stock exchange, whereas unit trusts do not trade on the stock exchange. To buy unit trusts, you will need to go to a unit trust consultant, whereas you can actually buy and sell ETF instantly on the stock exchange. That means you buy ETF just like you buy KLCI shares. Investors can buy or share ETF through Remisier or via online trading like handphone apps anytime during trading hours at the Bursa Malaysia. This gives investors the flexibility and price transparency to decide the entry and exit of ETF. ETF is a way of investing indirectly in stocks. By buying a portfolio of stocks, you also diversify the risk. However, investors' interests would be subject to the basket of stocks that make up the fund. These baskets of stocks share some similar characteristics. For example, some same geographical location, same equity class, same asset class, or the same industry. The majority of ETF are passively managed, which means they track an index. They are designed to track the performance of the index. What does it mean? It simply means they are designed to track the performance of the basket of stocks that make up the ETF. With this, it offers diversifications and track the market while retaining the features of convenience and flexibility of ordinary shares. ETF has a net asset value, or in short, we call it NAV, that is calculated with reference to the market value. NAV is the trading price of the shares held by the ETF, and this trading price is determined by the supply and demand of the market. I like to say that ETF in mature market like US, in the Europe, or even Taiwan are very popular and well received by ordinary investors. Next, we come to the advantages of ETF. I have actually listed down 6 advantages to be shared with every one of you. Number 1, low cost investment. The cost is cheaper than unit trusts, and any share price increase in the baskets of stocks would be reflected in the ETF. Likewise, any share price decrease will also be reflected in the ETF. Number 2, time efficiency. Due to work commitment, many investors do not have the time to monitor the progress of individual stocks. So ETFs are ideal for investors who lack the time. Number 3, flexibility. Buying and selling is done during trading hours, and investors can lock in the price immediately. If you notice your ETF suddenly starts tumbling, you can sell off your investment during market hours before the price of the ETF drops any further. Number 4, to buy shares, you will probably need to actually spend a lot of time and to read and so research about shares, because ETF allows investor access into a basket of stocks, so saving the investors effort and time in picking the right stocks to buy, because the stocks are all now packaged together. This is what we call diversification in the index portfolio. Number 5, it gave investors the freedom to buy and sell the units as they are traded like stocks. Number 6, offers better price and also liquidity compared to unit trust funds. You will probably ask, what are the disadvantages of ETF? Here are a few things to watch out for. Now, number 1, because ETF is similar to that of trading shares, investors should account for transaction costs and also the management fee. Example of transaction costs such as stamp duty and also brokerage commission, whereas management fees include the administrative costs and also fees by the ETF managers. The trading cost will add up if your strategy is to trade in and out of the ETF very frequently. Number 2 is the market risk. It is the same risk with stocks and also unit trusts. If the market performs well, then the return can be good. And if the market tumbles, then huge loss might happen. Number 3, too much of flexibility may not be good. Once you know exactly what the ETF is going to bring to your portfolio, stay away from excessive trading. The ability to move in and out of ETF quickly can lead to the temptations of jumping into markets or industries that you see potential for growth and come up when the performance drops. From a cost perspective, frequent trading could eventually lead to the brokerage commission exceeding the fees imposed by the unit trust funds. For this reason, it would be wise to think like a long-term investor and view the ease and flexibility of trading ETF as a just-in-case feature, only to be used when the market springs an unexpected and also unpleasant surprise. Next, probably you want to know how to start trading ETF. Now, you can use your existing CDS accounts maintained with your remisier. If you do not have a remisier yet, find a remisier to open a new trading account. And if you want to check and also know how much ETF you have, you can just check your CDS statements. Next is how to pick an ETF. Now, ETF is complicated as its underlying securities. If you know enough about what it holds, you know enough to invest in ETF. You need is a little due diligence on its investment and exercise some trading restraints. If you believe you can leverage on its unique design and also flexible nature, here are some tips on how to pick ETF. Step number 1. Anytime you came across a new product or a new asset class, go back to the asset allocations of the portfolio. Step number 2, investor must know the percentage each asset class should occupy. The importance of asset allocation cannot be overstated. Step number 3, many investors spend too much time and too much money picking individual stocks instead of evaluating what type of stocks or fixed income instrument they should be holding. Step number 4, after you identified the key areas of exposure in your portfolio, for example, a specific market or a specific industry or any stock type, then you start to identify the ETF available to you. Step number 5, read up the investment objective of each ETF and obtain its top 10 stocks holding or sector distribution to ensure it is invested in the industry or asset class that you want. Okay, I have come to the end of what I like to share today. Please help me to subscribe, like, and share my video with your friends. And also, please don't forget to click the little bell so that you are notified of any new video that I have. Thank you for watching. See you next time. Bye bye.